Herb, welcome back to the show. It's been a while.
Dan, I am thrilled to be here. Yes, it has been a while, too long.
Precisely, it has been since March 21st, 2022. We aired the previous episode that you did titled The Best Death Threat I Ever Got. Probably the best title we've ever published for the podcast. I just want you to know.
Well, I hope it generates some level of clickbait to get some people in before they realize what they were clicking into.
Yeah, no, it generated genuine interest. In fact, people really enjoyed it.
Yeah.
But the title. I mean, who wouldn't listen to that, right? I mean,
yeah, all true, true.
Yeah, crazy. Since it has been more than 2 years, like 2.5 years or so here, let's re-familiarize our listener with you. Before I got to know anything about you, you were always, hey, that short seller guy, or that guy who does short research. But maybe you could give our listeners just a little sort of background to remind them, since it has been way too long.
Well, one thing I'm not a short seller. Never have been. Likely never will be. But what I am is a guy whose DNA tilts toward raising the red flag on risk. And because I think in the world, when I started really doing this aggressively, in the world of doing this, the market, as we all know, is biased on the upside and biased on all things going up. And over the past 10 years plus, especially, I mean, I've been doing this for decades, but over the past 10 years, as the markets have shifted and the dynamics of the markets and the structure of the markets and the players in the markets have changed, there are always newbies coming in who just think that they're brilliant, and they think that it's just an easy way to make money. And for some of them it is, because maybe they have the right instincts to trade in and out the right way. But as so many learn, that there's this other side, and there are people betting against them, and they always don't realize the importance of understanding that risk until it's too late. And so thankfully, as I learned, is that this is who I am. And so it's been what I've been doing. I've been doing some level of, when I was a journalist, even when I'm not, I've been professionally working for the past 51 years. But I think that, starting in the late 1990s, when I went to the San Francisco Chronicle, that's when I really honed in as a journalist, and I had a column, and I was able to hone in on this whole concept of taking the other side of what most people were talking about and going down dark alleys. And I had a very good platform in the pre-internet years, which is very important. And so what I did is I sort of evolved that as I've gone forward, because it played truly to who I am. In fact, I worked through it in so many different places. And in fact, I'll tell you, for 2 years, until, just very recently, part of my career, because I like to take career risks for better or for worse, and I like to try new things. I was at the now former, or late, I should say, the now late Empire Financial Research, was a part of the Stansberry organization. And I went into it with great trepidation. But one thing, because of, things you and I have talked off cam about, which, have to do with promotion and the way that their style of marketing works, which is everyone has a different style of marketing. Marketing is critical, I might point out. But what I learned, one thing that intrigued me about that is I was now, for the first, not when I say for the first time in my life, I was going to be doing long biased research, because most of my research, which has been as a journalist, journalists, naturally, you're sort of looking for what can go wrong, right? That's how you're wired.
Right.
That's why most people are journalists. Then I had 2 short biased research firms over the course of time. Was at CNBC in the middle of that as the guy who was raising the red flags, for a few years, and I still, that's what I did. But when I morphed to the Empire 2 years, I started doing long biased research. And what's very interesting, when I was doing that, all I kept thinking about was, oh my, when am I going to write something that one of my short seller friends is going to hop on, is going to embarrass me? And so it actually, that bias and that DNA, which I know you have, is always back there when you're doing your research on something long biased, because you're trying to find out, you're trying to understand how can you be proven wrong. It's the first thing you're going to be thinking of. What's the risk here? What am I getting wrong? And then you can go into what is the reward and why is this such a good story in a world where there genuinely are good stories and good execution, versus, just promotion. So I actually did that for 2 years. I thoroughly enjoyed that component of it most of the time, because I had some great picks back at a time when the market was actually absolutely getting clobbered. I had some just, I mean, some really, it was really an enjoying relief to be able to do that. I used to say when I joined the Empire, I used to say I didn't want to end my life as being the grumpiest guy in the graveyard. And here I am.
Right.
Here I am now, post to that, having tried to start up between here and there, that, as they say, yada, yada, yada. And now I'm back doing what I love doing, which is writing, and raising red flags, largely raising red flags, but also some green ones, with my newsletter. So that is sort of the short version of what could be a very long version that I don't think there's any need to go through again. Anyone could go look at my LinkedIn and they can find the good, bad, and the ugly.
Okay. Well, that's valuable though, and you make a great point. Not only is there such a thing as human nature, but there's such a thing as Corey nature and Dan nature and Herb nature, and and knowing that about yourself is it's one of the best things you can do in life, isn't it? You can just, this is in my DNA. It's who I am. It's not going to change. I got to lean into it and just do it and be this.
Look, it takes all types, right? It takes
Mhm.
all types of people, and when it comes to investing, it takes all types of investors. And everybody's got a different strategy and a
Yeah.
different approach that works for them. Some people are naturally gunslingers. They're naturally, many people who are hedge fund managers and who are serious investors love the gambling nature of it, right? That's who they are. It works very well to them. They're wired that way. Their brains are wired that way. But there are plenty of other people who say, I'd rather think about something else when I'm going about my day than what's in my stock portfolio. And there are some people who prefer to be in those type of stocks, as opposed to just, what the headlines have you think about, everything that's moving fast, fast, fast. So I think you have to know that about yourself. And I think one of the things, for years, I couldn't invest in individual stocks because I was a journalist, and for decades, I was limited to mutual funds and things, pre-ETFs. That's pretty much what you're limited to. And that's not the same thing as buying individual stocks. And if I have one great regret in my life, it's that I wasn't able to, at least knowing what I know today. I'm not a good trader. And one thing I learned, I want to preface this by saying, when I actually could go into it, I dove in head first, as just, trying to figure out, was I really the trader I thought I was? The answer very quickly was, I am not. I don't have the psychological makeup to be one. I don't want to be one. It's not who I am. Am I the guy who's going to go with lottery tickets? Every now and then I buy a lottery ticket. Every now and then I might win, but they're not. Most of the stuff I'm in is pretty solid. But what I think you do is, when I look back, I think, gosh, what I've learned, because of the mistakes I've made, and it's all because of the mistakes I've made, and that's how you learn. I think that's how you learn how to be an investor. And if you approach it thinking, "Oh my God, I'm going to make a mistake," or "This is not," I think you're not going to move forward. So I think you have to go in and you have to identify that psychological makeup, and that not just psychological, just your skill set, going in, and know what your limits are and rise to your level of your incompetency, which is what I like to say, and take it from there.
Yeah. Yeah. Knowing yourself, know yourself. It's one of the all-time great bits of wisdom. And don't worry, Herb. We're all bad traders. Nobody's naturally a good trader. Nobody.
Yeah.
But some
Yeah, I
claim they
definitely remember
are.
my
Some
first failed
Oh,
trades
sure.
for sure. I remember mine. Yeah.
Yeah, that's right. We all
Look,
paid
I
some
was talking
tuition.
to a guy. The hardest thing to do, right, is to know when to sell. That is what people will struggle over. I don't care how
Absolutely.
long they've been in the business.
Yep.
When do you sell something? And I had a call yesterday from a guy who I think is really smart. He's been around almost as long as I have, except his whole career has been as a fund manager and as an investor, and he now just invests his own money, enough money that he always likes to say he has 10 lottery tickets and each one is 100 grand, and then that's just part of his portfolio. So he
Hmm.
called me because he just wanted to tell me that he he wanted to, just for some odd reason, he said, I just want to tell you, we have these discussions about when to sell. And he says, what do you do when a stock doubles? You've asked me, what do you do when a stock doubles? And he said, and he went through the people he's talked to who have all sorts of theories about what to do after a stock doubles. And
Hmm.
then he went through with his theory, which is different than their theory. And again, it works for him. But I think that was very interesting just to listen to. And I said, you know what? I'm out walking the dog. When I have a chance to get back in and think about it, I actually want to talk to you again about it because I just want to mull it over because my brain isn't wired again like some of these guys who can just think about it and it just works that way. Because I'm far right brain, and it's far right brain, you just don't absorb it the same way.
So wait a minute. What are you telling me there? You're telling me that I felt like I was on the cusp of an insight about selling,
Well, this the cusp
and
on
I didn't quite get it.
the inside on selling. Okay, that's good. You won't be the first guy who didn't get what I was trying to say.
Okay.
The cusp. What I was basically trying to say is everybody has their own approach on what works for them on how to sell. Some
Okay.
people are extremely disciplined, and they will tell you, as my friend does, how much
Hmm.
money they leave on the table, and they can't look back because that's their discipline. And
Hmm.
someone else will say, and again, it's stock by stock, the situation can change. But some people have very specific disciplines. This guy's discipline is different than another very smart guy who will say, there's the typical, you'll take 50% off. Some people say take 60% off. Some people, his view is take 25% off at a double. My point being that there's just, there's no one size fits all when it
Hmm.
comes to what you should do when it comes to the concept of when to sell a stock. It's still
Hmm.
something many people, including I think all three of us, likely anguish over, uh,
Absolutely.
either
I
from
don't think
time to
any.
time or
Yeah.
always.
I don't think anybody knows when to sell. I don't think Warren Buffett knows when to sell. I think that's why forever is his favorite holding period because he just wants a great business that'll compound over a long period of time because he knows I heard him tell the story of American Express one time. He was, he did all that work. It was the salad oil scandal, and he went to a store and just watched people use their American Express card. Everything went off without a hitch. He bought the stock. It was up 50% in a year, and he sold. It was still a great
It's
business. It's been a great business ever since and remains a damn good one today. And, he
it's
would
an
have went
art.
up. Yeah.
You go to somebody like Chris Mayer and who wrote 100
Yeah.
Baggers, and he has his style, and his style
Yep.
is he keeps up on his concentrated portfolio and he makes sure nothing's changed enough to scare him out of the stock. I wouldn't say scare him out of the stock, cause him to reduce his position or sell his stock.
Hmm.
But guys like that are the guys I admire the most because they
Yes.
really have the tenacity and knowledge to stay in it over the long term if
Yep.
indeed it still warrants that investment.
Yeah. When I think of
Yeah,
Chris
Herb, I
Mayer, I
think a
also
lot of
think of
the
Tony Deeden.
yeah, no, this whole conversation reminds me of just like the thing that trips a lot of people up is the difference between investing and trading. I think
Yeah.
is something as simple as that. Like a lot of first timers just get wiped out on short term moves, and then think are scarred by the stock market for a long time, but or cryptos at this point.
Hmm.
It's something I remember trying to learn in my early days, playing around with money.
Yeah. This makes me think of one of Bob Farrell's 10 rules. Bob Farrell, the 10 rules to remember. It's pretty
Right.
famous if you Google it. Right.
Yeah,
And
it's
I
great.
forget which number
They're
it
great.
was, but it was the one where he said, it was the one that resonated the most with me. I think it was number 6, actually, um, when he said, fear and greed are greater or outweigh long term resolve. And that's like my great mission with our listeners, with our readers, or subscribers to my newsletters and stuff, is to not let that get the better of them. Fear and greed outweigh the long-term resolve. It's really hard to be an investor, I think, is where I'm headed with this, because the
Yeah.
difference, people think they can be a trader because somehow they think it's safer to be in the market a shorter time. you know but
Yeah, I
it's
think
for most
that,
of us not.
and I think that's easy. I think that's easier said than done. And I think in a
Yeah.
world of FOMO and YOLO, fearing missing out, and you only live once. There's that dynamic until, of course, you lose money. And
Yeah.
once you lose money, that gives you discipline. I have this strong belief that in the world of the Reddit / Robinhood crowd, that there are a sliver of them, it's done a great job bringing people into the market. And as people lose money through the process, and the gamification of it becomes less fun because now it became real. Because it's one thing to go into a stock and say, oh, I can afford to, let's just say let's say somebody has $1,000 and they're going to invest in the market, and they say, oh, I can afford to lose this $1,000. And then suddenly the $1,000 that they put into to Peloton is worth $10 or whatever the case, $100. And they go, oh my gosh, this is horrible. I'm never doing this again. No more. I'm done with the stock market. But there will always be a sliver of them that actually say, hey, this is really interesting. And those people will go to the next level and try to
Yes.
learn, whether it's technicals and or fundamentals, or however they're going to do it, whatever their approach is going to be.
Yep. We've
And then
had
they'll
guests.
get more serious.
Absolutely. We have had guests on the podcast, more than one, many more than one, who will say, well, I got into it all during the dot-com boom and I lost a bunch of money, but I was hooked. So then they went from thinking it was really easy to make money in the stock market to being really interested in how it works and becoming a real investor. That's absolutely true.
Right.
Of course, it's a
Right.
small
Yeah.
percentage
Yeah.
of people.
Yeah, I
who
think
get
they
sucked
were
that way.
hooked by the making money part on the way up, and then
Yeah.
and then they lost it. But then they felt like they could do it again at some level. To your point, like learning the
Yeah.
technicals or whatever strategy, you might
Whatever
whatever works
works
for
for
you. To
you.
your point, yeah.
Yeah.
I put out my ideas, and again, most of them are sort of have some level of skepticism to them, because I think that's very important for people to constantly have hammered down their throat. But
Right.
I'm fully aware some people may take that information, and they may do nothing with it. Some people may short those stocks if they're still shorting stocks, or they may bet against it somehow in some hedge transaction. Other people may go long them because they think these are silly, and some of these might have big short interest, and they're convinced they're playing for the short squeeze. I'm agnostic to what somebody else does with their own money. I'm just trying to provide the information to let them know that there is risk. And as simple and basically pedestrian as that may sound, it certainly gets lost in the noise, especially in recent years. And when I say recent years, I think I could have had this conversation many recent years ago, thinking it was recent years because time flies. But there clearly are changes.
Yeah.
I think I've been saying that. So I think that's just, again, it's sort of the steady theme in everything I do, or much of what I do.
All right. So let's get the rubber in the road together here. One of your recent posts on Substack, says 2 days ago, is really intriguing, and it's got a great little graphic with it too. As I was reading RH's latest earnings call, I was stopped in my tracks when I read what the CEO said. And I'll tell you, you learn something from being with Empire for 2 years, because that one hooked me in. And then you call the post.
Well,
now I've heard everything. So I'm dying to know what it was. Yeah.
I was channeling my best Stansberry-esque / Empire lesson, the one I learned the most, that I forget the most, that you still have to be able to grab them. SEO be damned, as the case may be. So in any event, so that one was fun. I just published this. I don't know when this is going to run, but I just published this the other day on Substack / HerbGreenberg.com / Herb Greenberg on the street / Herb's red flags, or Herb Greenberg's red flag alerts. However you want to say it, that's my promotion for the show. Now, here's what it was though. It was you're reading the transcript. I was reading it because I've written about the company, and I wrote about RH, the former Restoration Hardware, for those who don't know, as a company that is a great example of a rational extrapolation, because investors will come into an idea because management puts out these fantastically wild forecasts. And the beauty of them is there's no way to disprove them. right? So I wrote an original piece going through restoration, the brilliance of Gary Friedman, the CEO, and how he's marketed the company. He built it up, rebuilt it up, blah, blah, blah. Now he's disrupting, he's doing something you never see. He's disrupting his own disruption again. He's disrupting the company that he originally disrupted with he had a new model. The new model worked, appeared to work, did fabulously well. The stock did phenomenally well. Short sellers got buried, blah, blah, blah. And now it's not working anymore. So he's literally disrupting it as he's trying to build out a global empire. So reading the thing, now the company has a ton of debt. And I'm reading the thing, hey, this is wild, this is fun. It's so fun. He's very fun to read, or I suspect listen to. He's on a different wavelength. And I hit the point. It's an answer. Someone asked a question about the company's ability to self-fund in the future and the ability to generate free cash flow. And he goes, we don't view debt as debt. We view it as a currency swap. And I'm like, whoa, wait, what? Wait, no. Ding, ding, ding. Wait, no.
I mean, if you're the Federal Reserve, you can view it that way, but otherwise, I don't get it.
So I go through, I go through this, and what he's written that, what he really views is he's taking his debt and he's using the debt to buy back stock. So from his perspective, and he's the largest shareholder in the company, so he has a vested stake in how all of this does. And so he's looking at this and he's buying back shares, but that's because this debt is really not, and he goes through the whole, it wasn't just a sentence. It was two or three paragraphs of him explaining why he meant this. Now, so I thought back and I thought, look, stock buybacks, they're fine. They work, especially if they're purchased wisely and if they generally do represent the best use of money that company has. And especially if it's from cash the company has on hand, not from debt, because we all know that's a red flag. I don't think you would probably recommend a company like that if you saw it. So I thought, let me think about what's another company that's bought back a bunch of shares. So this company's bought back about half its shares in the past 10 years, past 9 years, 10 years. So I pulled up Dillard's because Dillard's is the poster child, the retailer, the poster child for having bought back 62% of its shares. And when you put up the two charts, I have the two charts in the write up. You see Dillard's, and I pulled up the debt chart, net debt. Dillard's is straight down. Restoration Hardware is straight up. I should have just put them both on the same darn chart and just had one because it would have been a big X. And that shows Dillard shows you how it's done and how it can be done in a fairly healthy way. And Restoration Hardware shows you how it seems to be, how it's done if you're doing some level of what appears to be financial engineering. And you're basically just saying, trust us. And so that's why I say now I've heard everything, because I've never heard someone say we don't view our debt as debt. It's a spin. It's a distraction in my view. It's nonsense.
Yeah, it is nonsense. I love that. I will remember that forever. Our debt is not debt. It's a currency swap.
Currency swap.
Yeah. And, using debt to buy back stock, it's not necessarily the worst thing in the world. If you're Apple or somebody, maybe, I don't know. But
if you're generating gobs of cash and if your debt is there, debt is debt. And if things don't go right, that ultimately has a way of biting you in the rear. Yep. And I think that, again, everyone, look, if an investor, I always look at this. If an investor says, Herb, I think Gary Friedman, the CEO, is someone he's a moneymaker. I'm going to put my money behind him. I'm going to trust him. And I think that's what, and he's going to redo it. And this is going to become what he says it will become down the road. All the power to you. That's your money, and you should be able to do that. But I think people buying into it who may not understand the full risk need to understand that balance sheet. It's no matter what they say about it, it may become an issue at some point in time. It may very well not. But again, be aware of that risk.
And that is the point, isn't it? It's not that you're saying the stock's going to crash tomorrow. You're just going to say this unequivocally ramps up risk, whether you like it or not. And his story about
Yeah.
it not being debt is just baloney.
It's a great story and it's a great yarn, and he has people talking about it, and I
Yeah.
think that but he's he says outrageous things all the time. So you take that into consideration, but still, I think it's something that any serious investor would look at. And by the way, there's serious people who own this stock and people who believe in the strategy. And again, they're willing to deal with it because they believe he will transcend this once again, and his strategy will be borne out over time.
Right. And it seems there always are, there's always a serious person somewhere who owns it who you think, wow, they know what they're doing. But even those people don't get everything right. Warren Buffett hasn't gotten everything right. He's just gotten a bunch of things enough right to do extraordinarily well over a long period of time. It's kind of a good
That's right.
point. What this story is just everything these days, since I have my head kind of in this story, is reminding me of Michael Saylor and MicroStrategy, right? Borrowing lots of money and doing something with it that just seems like, wow, this can't last forever, can it? And having people say it's magic too. That was, if the debt is not debt, it's kind of like saying, oh, we're magically creating, value by borrowing money and buying Bitcoin, which, of course you're not, right? I mean,
well, it's interesting. It's interesting. I put a post up on I post on Blue Sky Threads and Twitter/X. Less on X, but still I'm there because it still is a referral network of sorts. And there's just still good financial community there. There's still a solid financial, investing
yes.
community there.
Yep.
And so I posted a thing on there after I saw Michael Saylor on CNBC a few weeks ago. And I said some comment because he sounded like it was one of those things you were listening to and you said, what's he saying? I mean, come on, what are you saying? So I wrote something like just a throwaway line. I said, it's a pyramid atop a pyramid. That's all I said. After just two sentences and a pyramid. That pyramid atop a pyramid resulted in nearly 800,000 views with thousands, I don't know, hundreds of thousands. It was the most reaction in 17 years of being on Twitter. I don't think anything has sparked any reaction more than that, both positive and negative against what I wrote. Because people think, there are people, in fact, people will say MicroStrategy is a pyramid scheme. Other people say, no, it's just a great levered bet. If you believe in Bitcoin, you need to own MicroStrategy because it's a levered way to supercharge your investment. So, it's interesting you bring it up because that, of all things, stokes so much emotion because of not just being Bitcoin, but being MicroStrategy.
Oh yeah, if you criticize this on X and you get a whole bunch of people saying you don't know anything about Bitcoin. Why do you hate Bitcoin? Why are you trashing Bitcoin? And I own Bitcoin. I'm not trashing Bitcoin. It's just the levered nature.
Myself.
Yeah, you see, it's the levered nature of the trade. It's and they say, oh, you're getting more Bitcoin per share. Yeah, but you're paying double, right? You're paying, the premium is 100%. In the stock, you're paying twice as much as the Bitcoin is worth. So, I think a lot of people don't understand risk. In other words, Herb, there are a lot of people in this world buying MicroStrategy who are in desperate need of your services. Put it that way.
Well, yeah, but I'll sit here being the guy I am, being the way I look at the world. I'll sit here and say, as I wrote it, I think I wrote something, or I put it on Twitter in that post. I said, I don't have a strong opinion one way or the other about Bitcoin. It's, I've owned the GPTC, one of the original trusted ETF in it a long time ago. I sold it when it went up. I don't personally own Bitcoin because I missed that boat, and whether I would have bought it, I don't know. I had a great opportunity once way back, and I think I would say I blew that. But again, I hadn't done the research, and I don't like to know buy things that I can't understand, or I don't have the time to just make sure I'm comfortable with. And people wrote me when I said, I don't have an opinion on this, saying, you're being intellectually dishonest. How can you say that? Because by virtue of saying that, that means you have an opinion. And I thought, no, I'm being intellectually honest, telling you I really don't give a damn. It's not my focus. My focus is individual companies. It's where I put, literally 90% of my time. And so, if I can't spend the time up for myself, then, it's not my bailiwick. It's not that I'm certainly aware of it, and I'll keep an eye on it. And if it collapses, maybe it'll be one of my lottery tickets in one of the ETFs. But
right. Right. But yeah, I mean, Bitcoin is, it's a whole topic that we could spend an hour talking about just that. But what I find really remarkable about this is the average sort of MicroStrategy kind of maxi diamond hands poster on X or someplace is seemingly unaware that if you did this exact same thing with any other commodity, they would probably see it a little better. But it's with Bitcoin, so it's magic. This is a magic way of amplifying the wonderfulness of Bitcoin, and it's
right.
not.
And
right, it's just not.
no, there's so many other, all the proxies. No, there's no magic in anything. We know that. And when people talk that way, you want to think.
I said it's Ike Batista without earnings or value creation, right? Just leverage on a commodity.
I had
leverage
somebody
on
write
leverage
in.
on leverage.
I had a reader write in the other day asking me what MicroStrategy actually does as a business.
Yeah,
they buy. Did you write back? They buy Bitcoin.
Yeah,
they buy Bitcoin.
Yeah. Yeah, they sell shares. They're in the business of selling shares and buying Bitcoin, and taking on debt and selling shares. And they issue these converts, and the converts are great for the ARBs because the stock is hugely volatile. So the arbitrageurs buy the convert, and then they sell the stock when it's high and they buy it when it's low. And they're the people for whom this is brilliant, right? It's wonderful. But so they're buying low and selling high. MicroStrategy itself is selling high. They said on October 30th, they're going to sell 21 billion of debt. As of our talk here in like mid-December, they've burned through 14 billion of that already. They're doing the exact thing you should do when your stock is in the stratosphere. They're selling it as fast as they can issue new shares. And there's a great appetite for it. So they're selling high. The ARBs are selling high and buying low. The diamond hands retail guys are buying high and holding on for dear life. Let's play find the bag holder. Right? I mean, who's the bag holder in that
well,
trio?
What we learned from 2021, which is really interesting about bag holders, is everybody was a bag holder. The beauty of 2021 was that the smartest of the smart thought they would outsmart everybody else. And you know what people always say when you talk to people, you say, "What do you do when such and such happens?" "Oh, don't worry, I'll get out." And then of course people get, "Don't worry, I'll be gone."
Yep, I'll be gone.
I'm sorry, life got in the way. So the reality is back in 2021, what was the beauty of 2021, which is like the dot-com era, which is why it's compared with that so much, is, every person who supposedly is at the top of the food chain of intelligence of investing was sponsoring a SPAC. Everyone was pulled in, it sucked everyone in. And I think that, including me, I mean, I made some, I lost some, but everyone was sucked in at that point because everyone you knew was involved. And I think everyone somehow in that era was a bag holder.
Yeah, I have to agree with you on that. It got us all to some degree or another. I wasn't wiped out or anything.
One way or the other.
One way or another.
No. You're a human. You are a human being. And when it comes to investing and speculating, because I can sit here and talk about, you do this, this, and this, but I'm no different than the next person. And every now and then you get an idea from one of your friends, or you see something, or you hear something, or you read something, you say, you know what? Okay. But it's all about obviously sizing and what you do. And there are certain things you can nibble away at, and other things you just make sure you don't hurt yourself. But you're a human being, and everybody gets sucked into that because maybe this was the one you would have missed. You know, yeah.
Yeah, you win some, you lose some. The best traders, the people who really are honest to goodness traders, including some market wizards that we have on the show, some of them will say, "Look, I'm right 40% of the time, but I make money, and I'm a market wizard." So it's clearly not about never being wrong, right? It's always about sizing and risk management, et cetera. That's a point that we always wind up here. We wind up here with all the traders we talk to. We wind up here with you, Herb. We wind up in this same place, talking about the need for risk management. And you can do like just about anything you want, but if you get the risk management part right, you're okay. You're not
Well,
going to blow up.
the smartest investors. It's this. Look, a lot of stuff I deal with is really simple in the sense of the rationale behind it, because the smartest folks I've dealt with in my career, whether back when I was interviewing money managers and the whole bit, it was always the smart ones always looked at the risk first and then the reward. It's the retail investors that are basically looking at the reward first and ignoring the risk because they're stumbling into it. It's why selling a short bias product to the retail investing crowd is very difficult because they don't understand the concept of the insurance or the need to understand the risk because they only want someone to tell them how to make money. And so they need to understand that there's also a reason to avoid losing money, which of course is one of Warren Buffett's, original rules. Rule number one, don't lose money. Rule number two, don't forget rule number one. But to many of these folks, that's just some old guy talking. And they figured out a new way to do it because all the old people don't know anything. And so, and then again,
Right. Right.
And then you become the old person who knows things and
absolutely
hopefully tries to tell other people what's going on. Yeah.
Oh, yeah.
Corey, they will be old too one day.
Yeah, that's right. And hopefully still financially whole
Yes,
on that day when they decide that they're old enough. Yeah.
I'm curious, Herb, from, obviously you pay attention to a lot of what's going on anecdotally, data-wise, and stuff. I mean, where do you think we are in terms of people getting sucked in right now? After the election, it seems like everybody's, I wrote the other day, it seems like anything is possible at this moment, and everybody kind of believes it.
Lots of optimism.
What's your sense right now?
I guess I watch it with the one metric I use. I have this list, a red flag alerts list, and I haven't updated in the past 3 weeks. And if I do, I know what I'm going to see. But when you see the shit goes rising, as they call them, pardon the phrase and the term, it's companies that are just generally perceived to be pretty crappy. They don't have any merits of rising and they're going straight through the roof. It's usually, historically, that's been an inflection point. Now, here we are at the end of the year where there's all sorts of there's all sorts of maneuvering going on because you have the element of the pod shops on top of everything else with the, those type of funds that are, positioning for the end of the year, selling, trying to make sure they're not losing money. So there's a lot going on. But beyond that, when it comes to next year, I honestly can't give you an answer because I don't know, because we have two elements of people. I mean, there's this guy I like to read. His name is Peter Atwater, and he has a newsletter called Financial Insights. And Peter's really fantastic at viewing the contrarian world. And his view, if you look at geopolitical, and I'm using his view, not my view, because this is what he does. And if he looks at, he's just recently today was just writing about how, so many American investors are just focused on the US and they're not focused on the world and what's happening geopolitically with Russia and China and some other things. And I think you see these elements of potential inflection points. And I would historically say, I used to say times like this were inflection points because, people like me, no one wants to say listen to because we're adding no value, because what's the point, right? And that historically been the beginning of the end. And then the beginning of the end of the bear would be when people thought I was a smart guy. So and they wanted to subscribe to my work. So, those elements, and I do think there's some change in that. I think that inflection point has not worked quite the way it used to. And because we have this element, we want to sit here and say, some of us want to sit here and say, there's such a euphoria over what Trump may do based on everything he said he's going to do, that once he actually is in there, it's sort of like, buying the rumor, sell on the news. But again, that's why it comes down to basically, gosh, hope you know why you own and what you own and why you own it, because that will transcend the times. Some of the garbage might not. I see there's one company I wrote about yesterday. I called it 2 days ago in a column or a piece I wrote called Dash for Trash. This company SoundHound, which is SoundHound AI. It has AI in the name. So SoundHound's been, the best performing AI stock in this universe and, this cycle, and this year. And if you look at it and you go, huh, what, how come? And it's not, so those of us who've been around can look at it and say, well, barring their ability to come out and raise more cash with the money they have, their stock price being where it is, at some point that game will end. And then if they raise cash, that game may end. So because they dilute everybody. So, you see that in this phase of the market right now, in this cycle. There are a number of names of things I watched that have literally boomeranged around and gone from the red, deep in the red, to very, wildly in the green.
Right. Since you mentioned SoundHound, I didn't know you had written that, by the way. Within the past month, I have bought a handful of puts a ways out on SoundHound because, well, I'm not going to say because why, because it's not investment advice. Do your own homework. I'm just putting it out there because I don't want to get in trouble with, with the folks I work for who don't like us, trading the things that we recommend.
Sure.
I don't recommend it. It's, it's just something that I happen to own. And in general, I do like the idea right now of, a small, we're talking about positions of like, tens of bips or something, small stuff in longer dated puts out of the money on absolute garbage that has gone straight through the roof with no fundamental underpinning on the absolute, ballistic ascension of some of these things. So just, generally speaking, I think we're on the same page there.
My subhead in my Dash for Trash piece was why SoundHound is a poster child for this cycle's FOMO follies. So, that to me sort of explains it, and what it's all about. Yeah. I have a picture of a guy running toward, he's dashing toward a pile of trash. So.
There you go. Perfect. No, I like your graphics.
Yeah, you said shitco before, and literally there's something in the crypto world called fart coin right now. That's been up. Well, it's up 170% in the last month, and it's literally one of these ones that just made up from nothing.
Yeah,
of course.
That shows you what shows you what's possible
let's not.
Here.
Yeah. Yeah, that one, and let's not forget Peanut the Squirrel coin, which has $1 billion market cap right now. It was Peanut the Squirrel was seized and euthanized by the state authorities in New York. It was a big story on the internet for a handful of days there, and they created a coin, and it's got $1 billion market cap. I mean, $1 billion. Which, it's just
in theory, that tells you a lot about this market and the direction we're headed. And the quality of some of the stuff that's, making people the most money right now, or at least on paper making them the most money, assuming they trade out of it when it's up here.
Yeah, and at the same time, speaking of another Bob Farrell rule, the strongest markets are broad, the weakest ones are narrowed down to a few names, and we're narrower than we've ever been. I think I looked today and Bloomberg's U.S. market cap index, I got 37%. It's never been 37% for the top 10 names before. It's enormous, enormous concentration, I should say. So by that Farrell rule, weakest market ever. And we've got all kinds of garbage soaring out of sight at the same time. So It's interesting. I won't, you won't catch me predicting downturns or predicting market action over some
Yeah,
short period of time. I, like you, Herb,
yeah.
we are, I believe, in the same camp, and you alluded to it earlier. It's in our DNA to worry about risk, to identify, as Howard Marks might say, to understand risk, recognize risk, and control risk. And that's all we're doing. Not making a prediction. You know.
That's all you can do. And
Yep.
the way I look at it is there's a market for it. And there are people who want to hear it, want to see it, want to continue to understand it. And even if they are not engaged in those names, they're learning something from reading about them, because it just goes into their body of knowledge, and
Mm-hmm.
for the next one or whatever else they're working on. It's
Right.
fascinating that way. And I've had people come into some of these things that I write about, raising a red flag, and it triggers something. It's funny how investors work. It'll trigger something, and they'll go dig deeper, and they'll actually find a long out of the concept. Or, you know, the best thing you can do when you're raising the red flag on risk is, and it's something it happened at the short research firm more than you'd believe, and that is, you'd write about a company, and somebody would go, I don't agree with you, but I'm going to go double up on my work. And then they said, oh my, you kept me from buying more. And as a result, from keeping them from buying more, those people avoided an enormous loss. And that's the beauty of it. A lot of people get complacent with their holdings, especially people in the investment community, because they have so many they're looking at, and they're comfortable names that have made them money in the past. And when a change occurs, they might miss the change. And
Mm-hmm.
if that's the case, there's levels of risk that even they forget, not
Yeah.
because they're overly zealous, just because everybody gets distracted by something else they're working on, and you lose sight of the ones that have not been problem children over years, perhaps, and then
Yeah.
they do become problem
You know,
children.
Herb, you point out an interesting thing here. And you've said this a couple times as we've spoken. Who knows how people are, when you're identifying risks primarily as you're doing, who knows how the reader is going to interpret and ultimately use, if at all, even your research. They could use it any number of ways, as you've pointed out. You've named some of them, and that is important because, on average, a lot of folks just like to have a ticker symbol dropped on them, and and be told to buy this right now, and you'll be golden. But arguably, that is, and we do lots of great work, and we deliver ticker symbols every month in our Extreme Value newsletter. And Mike Barrett and I do a lot of work. I'm not saying you shouldn't make long bets like that or deliver, actionable ideas right now. But what I am saying is that it's harder to describe how valuable what you do is in that way, but it is very, very valuable in a myriad of ways. When I tell you about one company, I've told you all about this industry, I've told you all about this company, I've told you all about what we think of the valuation, et cetera, et cetera. And I've told you something about the risk too. But when you're primarily focused on that risk piece, um, you've you've given me something that it's a tool, right? I can use that tool. I can use a hammer to do all kinds of things. I can use a screwdriver to do all kinds of things, and it's valuable. And I think I'm talking to the listener here more than anybody. I'm just trying to convince people, be more interested in understanding and recognizing and controlling risk, and read folks like Herb, because that's his whole career, man. It's his DNA. And I believe in it deeply as a primary part of the mission of folks in our business. Be about
Yeah,
understanding risk.
there's often a case where people will say, "Oh, that guy's just a short seller." Not me, but they
Right.
read something, they see somebody quoted, they hear something, they see something in social media.
Right.
And that means they always say, well, they're a short seller. They want the stock to go down, as opposed to someone who's long and wants the stock to go up. And I
Mm-hmm.
think that's the wrong approach, because there are plenty of bad short sellers and plenty of bad long investors and promoters on both sides, because
Mm-hmm.
everybody gets it wrong. But if you don't stop and pause, unless you know it, some people have done so much research, they can easily point a hole in a short seller's argument or in a long's argument. But beyond that, just to dismiss somebody because they're short of stock, or just to dismiss, oh, it's that guy Herb again. He's always they always say he's a short seller. He's got that. Whenever I see a defense, when I see an activist short seller come out with a piece, and the first thing the company says is they're short the stock, as if it's like some big bad thing. Well, that's short seller. In the activist piece, at the top of the report, it usually says, disclosure, we are short this stock.
Yes.
So the point, so they're basically trying to take something the short seller is telling you, and they're basically saying that this guy, you can't listen to him because we're the company, we know better. He's the short seller, she's the short seller, and they're just trying to drive the price down so they make money and they can cover their stock and go away. And you know what? Yeah, they probably are. That's why they're doing it. They're shorting the stock. They're publicizing their portfolio. Some of them are wrong. Some of them are overzealous. But man, some of the work is really good. So again, ignore it at your own risk.
That's right. There is not, and there is not merely like a long bias to the market action. There is definitely I would call it sometimes an extreme bias in the sort of finance establishment against short sellers, right? We're getting in the way of the commissions and stuff. We're getting in the way of gathering assets. We're getting in the way here to be identifying risks and potentially, selling short. But yeah.
Well, some countries ban short selling, and let me ask you this. Let me throw this one out to you. What's the possibility in this country there doesn't become a move afoot to ban short selling?
Well,
I mean, look, shorts and longs make markets, right? That's what makes a market. Without the natural buyer, there's no buying cushion. But what is the possibility with Donald Trump's presidency, since we know how he likely feels about short selling, that they try to pave the way for that. Not that that'll ever happen.
Not to mention the potential outcome. They banned short selling. I think it was 10 trading days, October 19th, don't quote me here, 2008 into November, or was it September 19th into October 8th in 2008? And what happened? Pinpoint from the day the ban started till the day after it ended, the bank stocks were the bank stock ETF was down. It was just down, 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 right? Because the market says, well, if you're banning short selling in 767 bank stocks, is what they did at that time. What does that tell you? You've shown your hand. You've told us to sell them because you're banning short selling because they're that bad off, right? So the market got wise to the ban and punished the sector. So you can't even do the ban anyway. It doesn't help anybody. In fact, encouraging an open dialogue, that open, active dialogue that has become muted in the age of so-called passive investing, which is not really passive, in the age of mindless buying, I would say, that's an issue, right?
And by the way, and you talk about passives and you talk about the world we're in right now. And one thing I often like to talk about is the inefficiencies created by the passives, because it's the stocks no one's paying attention to that still create a big inefficiency in what's perceived to be an efficient market. And I think that people forget that, because if you're looking for a long or a short or whatever it is, you go where everybody else is, and it's classic value investing. But that really, in this world, is I believe creates great inefficiencies. And I think when you look for those data points, those mosaics that are not generally out there, especially in companies that aren't as well covered, I do think you can find that level of opportunity, again, on both sides of the equation.
Yeah, I heard a guy say recently, for the coming regime, he expects like no S&P 500, no bonds. And I immediately went to Bloomberg and did a screen for, no S&P 500, because I thought, yeah, that's kind of what I feel like I want now. But of course, at this point with the concentration, the rest of the index is not performing so great. So there may be already some ideas in there is the point. But just starting with non-S&P 500 sounded like a good idea. As a way to start in and screen, I think it's an interesting idea.
There's some great ideas out there of companies that just lag. Yeah, go ahead. Sorry,
I was just going to say we're it's time for our final question. And I could do this for another hour. It's been really lively and fun with you, Herb. But our final question is the same identical question for every guest. You did answer it before. I hope you don't remember it. It works better that way, in my opinion. And it's the same question no matter what the guest, no matter what the topic. By all means, if you've already said the answer, you can repeat it. That's no problem. But the question is simply this. If you could leave our listener with a single thought today, Herb, what would you like it to be?
Well, I have no idea what I said last time, but I
Good.
can tell you that the single thought I have is do not ignore the risk. It's as simple as that. It's straightforward, and I can't. I can't put it any more simply than that.
All right. Do not ignore the risk. If there's a message for our time, I think you're at least in the top. You got to be in the top 3 perfect messages for this moment as we sit here mid-December
This
2024. Yeah. All right, Herb.
Yeah.
Thanks very much. It's always a pleasure to speak with you, man. And let's not wait 2 years to get you back.
Dan and Corey, this has been great. I've really enjoyed it.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.